What's up, everybody? It's Frederick Douglass Bussey. Welcome to another edition of Power Lunch. Today's solo cast, we're going to be talking about how to avoid a financial meltdown in your business, in life. Let's talk about meltdowns in general. What is it that makes people lose their minds? We got a lot going on. Talk about how you can preserve the things you built while continuing to expand exponentially. Let's go to work. Power Lunch podcast starts now. Welcome to another edition of Power Lunch Podcast. I'm your host, Frederick Douglass Bussey, and I'm excited to be here with you today. Today, it's all me, solo cast, but I think we've got some cool things to talk about. We're going to dig into it in a second. First of all, if you're watching this on YouTube, give us a thumbs up, subscribe, like, share on Facebook. Share this with somebody. Comment below. Let us know if you're watching this on Facebook or YouTube. Or LinkedIn. Let us know where you're watching this from, what you're getting from the conversation, what it sparks up for you. The entire point of this is to not just inspire and motivate, but actually educate, to stimulate thought, to be able to empower you to create the outcomes that you want most for yourself in your business. That being said, also for those of you who are building 7-figure plus businesses, feel free to join the 7-Figure Circle $1 Million Mastermind. This podcast is sponsored by the Mastermind. It's a free Facebook group full of trainings, different events that we have going on. We have a free masterclass coming up, a video marketing masterclass with my friend Juan Pa Otalaro, who runs Impact Creators. They help entrepreneurs to be able to brand their businesses and create more success through their businesses using video and video production. I think it's going to be really, really interesting. Some of the things that they talk about, tips, hacks, how to grow your audience on social media, things like that. It's going to be very, very impactful. I look forward to having you on there. So it'll be hosted live in the 7-Figure Circle $1 Million Mastermind Facebook group. You can go to my profile to check that out as well. The event profile is linked there as well. So that being said, let's dig into what we're talking about here. For those of you who are at all familiar with the tech landscape, financial landscape, you know about Silicon Valley Bank, which on Friday, March 10th, went into receivership for the FDIC. The federal government took it over because they were essentially insolvent. They didn't have enough money to pay their creditors. And if you've been following this story, then you kind of know what's going on. For those of you who don't really know what's going on, let me catch you up to speed a little bit. So essentially, Silicon Valley Bank is a bank that primarily focuses on or exclusively focuses on venture capital funds. They help companies that are startups, typically in tech or the financial sector, that space, to be able to start their companies. They take their deposits, things of that nature. They fund or loan out money to them. That was their clientele, right? So these are companies that are essentially startups. A lot of them are newer, a few years or less. And so they've got millions and millions of dollars in the bank with them. Silicon Valley Bank had about $200 billion in deposits. One of their problems, though, was that they what banks typically do is when they take your money in deposit, they turn around and loan it to other people. They put it into other investments to be able to make a return on it, so that even if they're loaning you the money or loaning it to other people, they're making a return on that investment, right? Okay. So people know that by now. The challenge with them was that they had invested into these bonds at a certain percentage rate of return, right? It was around 2% or 1 or 2% of return. However, because of inflation, the Fed raises the interest rates, which means that now the bonds that they're issuing are at a higher interest rate, maybe 4 or 5%. I think about 5%. So at that point, now the bonds that they bought before are undervalued, and it creates this gap, right? Unrealized losses, right? Because you have to hold the bonds for a certain amount of time to be able to realize the returns. But if you held them for that long, no big deal. But if other people want their money, now you got to sell the bonds to be able to get the money back, which makes you essentially insolvent. You don't have enough money to cover your losses. So Silicon Valley made a couple of mistakes, and we'll talk a little bit about what they did. But essentially, they had to do their quarterly earnings reports, and it comes out. And so the president's like, we're all good. Don't worry about it. But when they do that, there's a series of investors, VCs, who get together and realize, maybe I don't want to keep my money here if I don't know that I can get it out when I want to, right? And so rather than be the first rather than be last to get the money out, they want to be the first, because nobody wants to be last holding the bag and you don't know if you can get your money. And so essentially it created a digital run on the bank, right? People aren't standing outside in lines anymore at ATMs. They're not walking in and writing a withdrawal slip. They are going online and they're logging into their accounts and they're taking out their money. And essentially, in one day, the largest amount of a bank run ever in U.S. history happened. $42 billion was withdrawn from the bank, which was about 25% of their receivables, or their deposits or cash on hand, or actually assets, really, because they don't necessarily have the cash. But essentially the money that's on the books, 25% of that's gone in a day. And because of that, they couldn't cover the losses. The federal government comes in and takes it over. And essentially everybody else was frozen. So over the weekend, Janet Yellen announces that the government is going to cover all the losses and make the depositors whole, and nobody has to worry about it. So if you couldn't get your money over the weekend, then you're going to be good. They're going to make you whole. And so we're taping this on a Wednesday. It's March 15th. So by now, most of those people have been able to access their money, or should have been able to access it. But there's a couple of things that we want to talk about here about why these things happen, why there are meltdowns like this. And essentially, if you're if you're the owner of the bank, a stakeholder, as in you own stock in the bank, Silicon Valley Bank, if you're an employee, if you are a creditor, you are essentially out of luck because the bank no longer exists. And so $200 billion of value just evaporates overnight. You rank it as one of the 16th best banks, the 16th most powerful banks in the country, the United States, and now you no longer exist. How does that happen? How do you have a meltdown where something just evaporates overnight? And we've been seeing this happen more and more frequently. As a matter of fact, over the past weekend, Signature Bank, which was a bank that dealt primarily with crypto and lent money to cryptocurrency investors and things of that nature, they also had a similar issue and went down. I don't have all the details on that, but you can go and look that up about Signature Bank. And so what we're seeing is that these issues arise, and sometimes we ask ourselves, well, how does this happen, right? These people are supposed to be trustworthy. They're supposed to be smart. They're supposed to be great business people, or whatever the case may be. But the one thing that's undefeated in all these scenarios is human psychology, human behavior, human thought patterns, right? People behave a certain way for different reasons, or for very specific reasons. And if you're not clear about what that is and why that happens, then you're not aware enough to understand, one, when to recognize when it happens to other people, when it's imminent danger, you and your company, you and your people that you love are in imminent danger. And that danger also extends inwardly as well. When we are caught in certain thought loops or certain patterns that put us at risk of losing everything that we have. And so I kind of want to quickly talk about a few of those things and hopefully give you something to think about as you're leaning into growing your business, as you're leaning into understanding how you can continue to accelerate the success that you've achieved in your life so far. There's a couple of things that happen, right? When you look at what Silicon Valley Bank did, they made a couple of mistakes. And then there were a couple of things that stand out as red flags that also give us an insight of what they're thinking. One of the mistakes that Silicon Valley Bank did was, although they were smart, and I saw this article in Fast Company, and we're talking about one of the biggest mistakes that they made which is a key mistake was that they did not diversify, right? And so they had all their eggs in one basket. And there are certain business principles that you need to apply, right? So if you have a customer and you want to be efficient and effective, you do want to focus primarily on one area first because you want to get productive in that area. But once things are going well, you need to diversify to dilute the risk, right? They did not do that. And so all their eggs are in one basket. And so when the inflation hit and the interest rates rose, they were stuck and there was essentially nothing they could do about it. And so because of that, it highlights one of the factors of human psychology that tends to take over, which is that we typically like to be comfortable and like to be safe. And so when things are going well, we stay safe, right? It's safer to just continue to build off the momentum. And we typically, as we see in the housing market and so many other markets in 2008, right? There's this belief that things are always going to keep going well because they've always been going well, as long as we can remember. Even when things break down, like this situation with Silicon Valley Bank, right? In a few weeks, people will forget about it. And people will go back to things the way that things were because the government has stepped in to make the depositors whole. So nobody essentially gets hurt other than the people who were at the bank and the investors in the bank. But secondly, is because also when people look at what happened to someone else and the pain is not felt by them primarily, we don't learn the lessons. And we can also dismiss it and say, well, we're not really in that same boat. And people are starting to examine other regional banks, other small mid-sized banks, because they're looking at their behavior and the regulations that are going on with that. And they're asking themselves, hey, are these situations really safe? This is something that we get to examine with ourselves. When we look at mistakes that other people make in their businesses, when we see other people blow things up in their lives, are we asking ourselves the same thing? Are we essentially being able to create another level of success? As my daughter comes in, you coming in to say hi? Say hi, everybody.
Hi.
Okay.
I was going to tell my daddy what Robo was, how he was counting the grass. He was like 511.
511, yes.
Yes.
All right.
It's creepy.
Yes. Thank you. You can close the door for me? All right. The joys of doing things live. So we see that many of our when we look at mistakes that other people have made in their businesses, one of the challenges that comes up is understanding how we can learn from these mistakes and not blow ourselves up at the same time as well. And having those fail safes, those boundaries in place, right? So there are certain things that we need to automate in our lives where we have boundaries and checks and balances to be able to restrict us. One of the challenges that entrepreneurs have is that we don't like controls. We don't like giving up controls. We don't like not people telling us what to do, right? If you're a high achiever and a high performer, sometimes you get rewarded for bad behavior or get rewarded for a certain behavior. It's very difficult to break those patterns. You've got to learn how you can put those checks and balances in place, have those fail safes in place, and learn to accept the discipline, right? Sometimes in the tech world, they call it taking your medicine, right? In the business world, when you realize, hey, we made a mistake, we've got to learn this lesson, we've got to take our medicine. But very frequently, what we want to do is we want to be able to control that, limit how much medicine we have to take, limit the pain that we're feeling. And sometimes you need to learn to absorb the pain, absorb the hard lessons, right? Take the write down, whatever it is, so that you can be better off in the future. If we have a habit of minimizing the pain, of deflecting, of avoiding the consequences, then we don't learn the lessons that we need to be able to just bolster us for the future. And so creating that discipline in your life, creating those habits, creating those boundaries, that can be people that are in your life, people that are not just yes men or yes women, right? But have the authority to speak to us and tell us when we're wrong. And that we have a commitment, a covenant with them, if you will, to listen. There's some skin in the game for us. This is why coaching is a very valuable thing, because when you're paying someone to give you objective feedback, to actually help you work through and navigate through your own thought processes, You don't get stuck in your own head. You don't get stuck in your own patterns. You don't get stuck in a comfortable place, and you don't end up making huge mistakes, huge errors, because you are committed to this path of action that keeps you where you want to go. We are very much, as creatures of habit, conditioned to the status quo. And there's nothing that will condition us better or more deeply than when things are going well. And Silicon Valley Bank, for example, was doing gangbusters for years because the money was flowing. Interest rates were essentially zero. The money was essentially free. And so people could make these investments, these bets with a huge upside. And the idea was that this was just going to continue ad infinitum. And that's just not the case. Nothing goes on forever, right? And we have to understand there's peaks and valleys, there's highs and lows, there are ins and outs. There's going to be turbulence as well as there's going to be smooth and clear skies. And we've got to learn how we can navigate those things. So having those things in place is very, very important. The other thing I want to talk about is margin. Creating margin. I talk about this a lot, how you want to create margin in your life, but there is a great phrase, margin for error. And the more margin you create in your life, right? So thinking bigger, I always talk about thinking bigger, gives you more margin for error because now you have more at play. What happens though is that sometimes we have what's called lifestyle creep, which essentially means that the more you make, the more you spend. And it's because you have the luxury of being able to do that, and that makes you more comfortable. You expand into that comfort. And so how can you essentially create a level of my camera's gone off. It's got too overheated. Let's see if we can get it back. And we're back. All right. So how can we essentially create more margin for error, right? Now we're going to run out. We're just going to overheat here. This is going to be an audio off podcast. Video off for the remainder. All right, we'll take the time and do this, but I'm just going to talk about it, talk through it for a second while we're doing that. Creating more margin for error is very, very important. If we can do that, what we can do is we can allow ourselves to be able to navigate the ups and downs without blowing ourselves up. Essentially, we have an emergency brake. Essentially, we have a buffer, a seat belt that's going to be able to allow us to hit the wall if things go against us, and yet at the same time, be able to survive the worst effects of it, right? So that's the downside. Keith Cunningham always talks about understanding what's the downside and engineering yourself towards that to make sure that the first thing that you do is don't blow yourself up. How do I ensure that I don't blow myself up, right? And that's what we're trying to tack towards. So we can always be keyed in on that and making the best out of every situation, right? So with that being said, what are your thoughts on this? What would you do differently in your case? What can you do differently now to be able to ensure that you don't blow yourself up, that you're geared up for success? Yes, but that failure is not the option that's going to happen for you. How can you make sure that you're not going to blow yourself up? What is all deliberate speed, as the Navy says, right? You want to move in the right intention to be able to create the outcomes that you want for yourself, and to ensure that the outcomes that you don't want to blow yourself up, that doesn't happen. Drop your comments below. Let me know what you have to say. If you're watching this on replay, drop a hashtag replay. And please, for the love of everything that's holy, subscribe to our YouTube channel. We want to get our subscribers up so we can continue to reach more entrepreneurs and leaders and be able to help and empower them to be able to think about these things. How can you be a better leader? How can you be a better entrepreneur? How can you continue to create the impact and the results that you want in your life to get the things that you desire the most and can be most significant and meaningful for yourself and those you love? All right. As always, my name is Frederick Douglass Bussey. This has been another edition of Power Lunch, and I hope that it was valuable for you. As always, ever forward.